Joining us now is Robert Kaplan, former president of the Dallas Federal Reserve and currently co-chair of the Draper Richards Kaplan Foundation. Robert, good to see you again on CNBC. Thank you. I hope I made the point. New York Community Bank is not some small local bank with a couple of branches. This is a gigantic bank.
It's the 35th largest bank in the United States. And just for context, there's 4,150 banks in the United States. The
top 2%.
There's only 35 or 40 banks in the U.S. with assets over $100 billion. And to your lead in, over the last year and a half, you always ask, is there an asset liability mismatch? I think most banks have cleaned that up to the extent they had that exposure, meaning they had a lot of excess deposits and they bought long-term treasuries and other assets. That's one issue. Regulators and boards are also looking heavily at percentage of uninsured deposits because that makes you vulnerable to deposit flight if there's stress. And then the third big issue, which was the surprise here, is the size and the quality of the loan book. I was actually surprised, given how big this bank is. Every bank board meeting I'm in, there's an obsession with making sure they're properly provisioned for commercial real estate, particularly office. Yeah. And so I think that's why the market was so surprised that they announced a surprise increase in loss reserve, because this has been a long-running focus, and it sounds like this bank came to it a little bit late.
Do you think the market's overreacting here?
The market's doing what it always does when there's a surprise. It's now scrubbing every other bank for its commercial loan exposure, commercial real estate exposure, and trying to figure out whether they're properly reserved. Normally, when the market has to react, rather than the supervisors and regulators being out ahead, the market almost always overreacts, as it did last spring, and things will settle back down. But the market is hunting for any other banks that might be under reserved. My guess is, because this has been such a focus, I would hope that between the regulators and bank managements, this situation will turn out to be unusual, but we don't know. And what the market does when in doubt, it shoots first by selling and asking questions later. So I would hope that this will settle out over the next several weeks. This bank, though, unfortunately has $110 billion in assets, and it's got a market cap now of $3 billion, meaning on the market basis, it's dramatically undercapitalized. And this is where management and regulators are going to have to figure out how to deal with this.
We got to get to Rick in a second, but I want to ask you this, Robert. What happened? Okay, we can agree the San Francisco Fed was asleep at the switch, was Silvergate, Silicon Valley. Maybe you won't agree with that. I said it. You don't have to. I thought that was almost a year ago that we had that sort of regional bank crisis. How did this go unnoticed?
Yeah. So normally, when there's a problem at a bank, it's normally not because they own too much in the way of treasury or treasury related. That's what happened last spring. They owned so much of it, and when rates went up, they just lost a lot of money. This is an old-fashioned credit loss. And yes, I think most banks are all over commercial real estate. It's been well advertised that there are problems in commercial real estate. So I'm surprised that managements were slow on this at this bank, and that the regulators, I'm sure, are kicking themselves that they didn't scrub this loan book better to prevent this kind of surprise. But again, I hope it's not very widespread.